Look, I need you to pay very close attention to what I'm about to show you, because what's happening in the silver market right now is something most people won't see coming until it's too late. And by then, the opportunity will be gone. Right now, as I'm recording this, silver is trading in a range that's creating what technical analysts call a coiled spring pattern. But here's what makes this different from every other time we've seen this setup. The fundamentals backing this move are unlike anything we've witnessed in modern market history. Let me paint you a picture of what's really going on behind the scenes. You've got central banks around the world that have been on an absolute buying spree. Not just any buying spree. We're talking about accumulation at levels that would have been considered insane just a few years ago. The People's Bank of China has been adding to their reserves month after month. Poland's central bank has been stacking. India's been buying. Even countries you wouldn't expect are quietly building positions. But here's where it gets interesting. While gold gets all the headlines, and don't get me wrong, gold's having an incredible run, silver is sitting in the shadows, coiling up like a rattlesnake ready to strike. And the smart money knows it. Let me tell you about something that happened recently that should have made front-page news but barely got a mention. A major industrial manufacturer, one of the biggest in the solar panel industry, had to halt production at 3 of their facilities. Not because of labor issues, not because of supply chain problems with other materials. They couldn't get enough silver. The physical metal simply wasn't available at the prices they needed to keep their margins intact. Now, you might be thinking, okay, so one company had a problem, so what? But this isn't an isolated incident. This is a symptom of something much bigger that's been building for years. Silver has this unique characteristic that makes it different from almost every other commodity on the planet. It's both a monetary metal and an industrial metal. Gold is primarily monetary. Sure, it has some industrial uses, but the vast majority of gold demand comes from investment and jewelry. Silver? It's the workhorse of the modern economy. Every solar panel requires silver. Every electric vehicle uses significantly more silver than a traditional car. Your smartphone has silver in it. Medical equipment relies on silver. The electronics in your home, your car, your workplace, silver is everywhere. And here's the kicker. Unlike gold, most of the silver used in industrial applications is consumed. It's gone. It doesn't get recycled because it's not economically viable to extract tiny amounts from circuit boards and solar panels. So you've got this situation where industrial demand is absolutely exploding. And I mean exploding, while above-ground stockpiles are being drawn down. The Silver Institute's data shows that we've been running supply deficits for years now. Not small deficits, significant ones. And yet somehow, the price hasn't reflected this reality. Yet. Let me take you back to a moment in history that rhymes with what we're seeing today. In the late 1970s, silver was trading around $5 an ounce. Most people ignored it. Gold was getting all the attention as inflation raged and the dollar weakened. But a few people saw what was coming with silver. They understood the supply-demand dynamics. They recognized that silver was undervalued relative to gold, relative to its industrial importance, relative to everything. By January of 1980, silver had rocketed to $50 an ounce, a tenfold increase in less than 2 years. Now, I'm not saying we're going to see that exact scenario play out again. History doesn't repeat, but it often rhymes. What I am saying is that the setup we're seeing now has some eerie similarities. Back then, you had inflation concerns. Check. You had geopolitical tensions. Check. You had a weakening dollar. Check. You had industrial demand growing. Check. But here's what's different now. The industrial demand side is exponentially larger. The green energy transition alone is creating silver demand that dwarfs anything we saw in the 1970s. Think about what governments around the world have committed to. Net zero emissions targets, massive solar installations, electric vehicle mandates. Every single one of these initiatives is silver intensive. The International Energy Agency estimates that silver demand from the solar industry alone could triple over the next decade. Triple. And that's just one sector. Now let's talk about what's happening on the supply side, because this is where things get really interesting. Silver mining isn't like flipping a switch. You can't just decide to produce more silver overnight. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is largely dependent on the economics of mining these other metals. And here's the problem. Many of the world's largest silver-producing mines are aging. Production is declining at existing operations. New discoveries are rare. The easy silver has already been found and mined. What's left requires more capital, more time, and higher prices to make economic sense. I spoke with a mining executive recently, someone who's been in the industry for 30 years, and he told me something that stuck with me. He said, "We're not finding the big deposits anymore. The ore grades are declining. And even when we do find something promising, it takes 10 to 15 years from discovery to production. The silver that's going to meet demand 5 years from now should have been discovered 10 years ago, and it wasn't." Let that sink in for a moment. The supply that's needed to meet the demand that's coming, it's not there. It's not in the pipeline, and the market hasn't fully priced this in yet. Now, here's where I want to take a brief detour, because if you're someone who's thinking about your financial future, your retirement, your wealth preservation strategy, this matters. A lot of people don't realize that you can actually hold physical precious metals in a retirement account. It's called a gold IRA, and it works with silver too. If you've got $100,000 or more in retirement savings, I put together a free guide that explains exactly how this works, how you can get physical metal into your account without triggering taxes or penalties. It's in the description below. Worth checking out if that's relevant to your situation. All right, back to what's happening in the market right now. So we've established that demand is surging and supply is constrained. But there's another layer to this that most people don't understand: the paper market versus the physical market. On the COMEX, the commodities exchange where silver futures are traded, there's a massive amount of paper silver. Contracts that represent silver but aren't actually backed by physical metal in a vault somewhere. It's a fractional reserve system, similar to banking. For every ounce of physical silver, there are multiple claims on that same ounce through paper contracts. This system works fine when everyone's playing along, when most contracts are settled in cash rather than physical delivery. But what happens when people start standing for delivery? What happens when industrial users who actually need the physical metal start demanding it? What happens when investors lose faith in paper promises and want the real thing? You get a squeeze. A short squeeze on a scale that could make the GameStop situation look like a minor blip. Because unlike a stock where a company can issue more shares, you can't just create more physical silver out of thin air. It either exists or it doesn't. And there are signs this is already starting to happen. Premiums on physical silver, the amount you pay above the spot price to actually get coins or bars in your hand, have been elevated for months. Delivery times from major dealers have been stretching out. These are the early warning signs that the physical market is tightening. Let me tell you about what happened during the last major silver squeeze in 2011. Silver went from around $17 at the start of the year to nearly $50 by April. It wasn't a gradual climb, it was explosive. And what triggered it? A combination of investment demand, industrial demand, and a recognition that the paper market was overextended. But here's what's different now. The industrial demand base is so much larger. Back in 2011, solar was a tiny fraction of what it is today. Electric vehicles were barely on the radar. 5G networks didn't exist. The amount of silver required for the technology we use every day has multiplied. And then there's the monetary aspect. We're living through the largest monetary experiment in human history. Central banks have printed more money in the last few years than in all of previous history combined. That money has to go somewhere. It's searching for stores of value, for assets that can't be inflated away. Gold has been the obvious beneficiary. But silver? Silver is gold's little brother that's been overlooked, undervalued, and ignored. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio has been somewhere between 15:1 and 30:1. Recently, it's been trading above 81. That's not normal. That's not sustainable. And when it corrects, the move in silver is going to be breathtaking. Think about it from a simple supply perspective. There's roughly 8 times more silver than gold mined each year, but silver trades at a fraction of gold's price. If you believe gold is a store of value, and clearly central banks around the world do, given their buying patterns, then silver at current prices is absurdly cheap on a relative basis. Now, I want to talk about something that doesn't get enough attention: the role of silver in the de-dollarization trend that's accelerating around the world. Countries are looking for alternatives to the dollar for international trade. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working on alternative payment systems. They've been talking about a commodity-backed currency. What commodity do you think they're looking at? Gold, obviously, but also silver. Because silver has that dual nature. It's monetary and industrial. It's useful. It's tangible. It's finite. You can't print more of it. You can't devalue it with a keystroke. As the global monetary system evolves, and it is evolving, whether we like it or not, precious metals are going to play a larger role. And silver, with its industrial applications and monetary properties, is uniquely positioned. Let me share something that happened recently that really crystallized this for me. I was looking at import data from India, one of the world's largest silver consumers. Their imports have been surging, not just for jewelry and investment, but for industrial use. India is building out massive solar capacity. They're manufacturing electronics. They need silver. Lots of it. At the same time, I'm seeing reports of tightness in the London bullion market. Delays in deliveries, premiums widening. These are the kinds of signals that precede major price moves. The physical market is sending a message that the paper market hasn't caught up to yet. And here's what keeps me up at night. In a good way, if you're positioned correctly. The vast majority of investors have no exposure to silver. None. Their portfolios are stocks, bonds, maybe some real estate. They're completely unprepared for what happens when inflation really takes hold, when currency debasement accelerates, when the industrial demand for silver collides with supply constraints. When those investors wake up, and they will wake up, where do you think they're going to turn? They're going to look at gold, see that it's already had a massive run, and then they're going to discover silver. They're going to see that silver is still relatively affordable, that you can buy a meaningful position without needing hundreds of thousands of dollars. And they're going to pile in. That's when the real move happens. Not when the smart money is accumulating. That's happening now, quietly, behind the scenes. The real explosive move happens when the crowd shows up, when your neighbor starts asking you about silver, when mainstream financial media can't ignore it anymore, when silver becomes the story everyone's talking about. We saw this pattern in 2011. We saw it in 1980. We're going to see it again. The only question is, are you going to be positioned before the crowd arrives, or are you going to be chasing the move after it's already happened? Let me walk you through what the technical picture is showing right now, because this is important. Silver has been consolidating in a range, building a base. Every time it dips, buyers step in. Every time it rallies, it holds higher lows. This is classic accumulation behavior. Big players are building positions without pushing the price up too quickly. They're being patient. They're being strategic. But that consolidation phase doesn't last forever. Eventually, the coiled spring releases. And when it does, the move is typically violent and fast. We're talking about the kind of price action where you wake up one morning and silver is up $3, then $5, then $10. And by the time you decide to act, you've missed the best entry point. I've been watching the options market too, and there's something interesting happening there. Open interest in call options, bets that silver is going higher, has been building. But it's not retail speculation. The positioning suggests institutional players are hedging, preparing for upside. They're not betting the farm, but they're making sure they're not caught flat-footed if silver takes off. And then there's the short interest on the COMEX. Commercial traders, the big banks and institutions, have been net short silver for years. It's been their trade. Short paper silver, suppress the price, rinse and repeat. But that positioning is starting to shift. Short covering has begun. When the big shorts start to cover, when they flip from suppressing price to chasing it higher, that's when you get parabolic moves. Here's something else to consider. The geopolitical landscape. We're living in an increasingly unstable world. Trade tensions, military conflicts, political upheaval, sanctions and counter-sanctions. In times of uncertainty, people flee to safety. They flee to tangible assets. They flee to things that have held value for thousands of years. Silver has been money for 5,000 years. It's been used as currency, as a store of value, as a medium of exchange across every civilization. That's not going to change because some central banker decides to print another $1 trillion. If anything, it makes silver more valuable, not less. I want you to think about your own situation for a moment. If you're holding cash, you're losing purchasing power every single day. Inflation, real inflation, not the manipulated government numbers, is eating away at your wealth. If you're in bonds, you're getting a negative real return. Stocks are at nosebleed valuations, propped up by central bank liquidity that can't continue forever. Where's the asymmetry? Where's the opportunity for significant upside with limited downside? Silver at current prices offers that. If I'm wrong, if silver just sits here and does nothing, you've got a tangible asset. that holds its value. But if I'm right, if the supply-demand dynamics play out the way the data suggests they will, you're looking at multiples on your investment. Think about the risk-reward. Silver could go down 10 or 20% from here. Sure, anything's possible in the short term, but it could go up 100%, 200%, more. The asymmetry is heavily skewed to the upside. That's the kind of setup you don't see very often in markets. And here's the thing about silver that makes it different from speculative plays. You're not betting on a company's earnings. You're not hoping a CEO makes the right decisions. You're not dependent on a business model working out. You're buying a physical element that's in finite supply and growing demand. The fundamentals are simple, the story is straightforward, and the outcome, while not guaranteed, is highly probable. I've been in markets long enough to recognize when something special is setting up, when all the pieces are aligning, when the fundamentals, the technicals, the sentiment, the macro backdrop, when everything is pointing in the same direction. That doesn't happen often, but when it does, you need to pay attention. Right now with silver, we have that alignment. We have supply deficits. We have surging industrial demand. We have monetary debasement. We have geopolitical instability. We have a paper market that's overextended. We have physical tightness. We have institutional accumulation. We have a gold-to-silver ratio that's historically extreme. We have a technical setup that's coiled and ready to spring. All of these factors are converging at the same time. That's not a coincidence. That's not random. That's the market telling you something. The question is, are you listening? I'll leave you with this thought. In every major bull market in silver, and there have been several throughout history, there's a moment when the move becomes obvious to everyone, when the trend is undeniable, when the gains are so large that they make headlines. But by that point, the easy money has been made. The people who profit the most are the ones who positioned themselves before it was obvious, before the crowd showed up, before the mainstream caught on. We're in that before phase right now. The smart money is accumulating. The data is screaming. The setup is there. But most people aren't paying attention. They're distracted by the latest stock market drama, by crypto volatility, by whatever narrative the financial media is pushing this week. Don't be most people. Look at the data. Look at the fundamentals. Look at what's really happening beneath the surface. And ask yourself, does it make sense that silver, with everything going on in the world, with all the demand drivers in place, with supply constraints tightening, should be trading where it is today? The answer, if you're being honest, is no. It doesn't make sense. Which means one of two things. Either the market is wrong, or the market hasn't caught up yet. And in my experience, when fundamentals are this strong, the market eventually catches up. It always does. The only question is whether you're positioned when it happens.